All right. Happy Monday market update. I am Matt Gouget, affectionately known as Matt the Mortgage Guy. I've got the loan wizard, Mr. Nash Paradise, with me. And for anybody who likes action, who likes volatility, it is a great week for you because we've got a lot of action. We're going to talk about the reason we're seeing so much volatility with mortgage rates and in the bond market. We'll talk tariffs. We'll talk, economic news like we always do. How you doing, Nash?
I'm doing good, man. I'd be doing better if it wasn't for all this volatility. It's not a good time. Not fun. Don't love it.
Yeah.
Consistency is key. But, I mean, we're going to take what we can get and figure out how we can get some talking points out to everyone and what's going on.
Yeah, sounds good. I know some people, kind of crave the excitement. But like we talked about in past Monday market updates, for my clients and for me personally, I like a little bit of certainty, a little bit of, knowing that we're going to fit into a range and not have wild swings day to day. So yeah, let's jump into the slides. We'll talk about it in more detail. But first, tell us, about the economic news from last week and what we're looking forward to this week.
Yep. Looking at last week's key figures here, ISM manufacturing last Tuesday was fine. It was totally square. It's where we thought it was going to be. Wednesday was when we had the announcement for the reciprocal tariff plan. That was huge, moved the market pretty good, but not quite as violently as it did Thursday, Friday. The interesting thing about last week is, Friday is the day that we had circled on the calendar for, economic data reasons. We have non-farm payrolls and unemployment rate that were coming in. Those moved the market a lot. The interesting thing about non-farm payrolls to me is actually the revision from the February figures. February figures were revised from 151,000 jobs added down to 117, which is pretty significant. The forecast for the March numbers were 135,000 jobs added, and it came in at 228,000. So, the president tweeted about that. It's pretty big news. The U.S. economy added a whole lot more jobs than were anticipated. Interesting. But then unemployment rate came out, and it was targeted for 4.1%, went up to 4.2%. So we have this combination of, adding a lot of jobs, but employment rate going up. It left investors a little unsettled last week, but it was the tariff stuff. That's what went nuts on Thursday and Friday. We saw massive swings in the bond market. We saw the 30-year fix drop to the lowest rates that we have seen since I think it was September of last year. So wild stuff going on last week.
Yeah, for sure. Sorry to interrupt you. Yeah, I think it was like either September or October of last year, our lowest rates since then, which is a good thing for people who are looking at locking a low. We'll talk later too about, I haven't asked you this yet, but what we think about locking or floating in an environment like this. All right, what do we got next? We got this week's economic news on the next slide.
Yeah, I'd like to think this week matters, but I mean, does it matter? We've got nothing real interesting coming on here. I'm looking at a slightly different graphic that goes in a little bit more detail. We've got the FOMC minutes on Wednesday that could be interesting. But other than that, like the big stuff is Thursday. Thursday is the day to circle this week. We got month over month core CPI coming in. Interesting thing here is the target for the core CPI is actually up from 0.2% to 0.3%. So anticipating that month over month inflation data to increase, but then the year over year core CPI from 3.1% to 3.0%. So this year consumer price index, is, month over month inflation supposed to go up, year over year is supposed to go down. So it does give us this propensity for some mixed messaging. So hopefully that keeps things fairly even throughout. Looking at Friday, we've got the producer price index, food and energy year over year coming in, a couple of those consumer sentiment indexes coming in, a few of the, Fed chief speaking. We've got a lot of interesting things coming on this week, but let's be honest, Nothing matters this week except what's coming from the White House. We saw, and I think now is a good time to talk about what we're seeing right now. Saw the tariff stuff last week, dropped the interest rate significantly. Well, this morning, news comes out that said, oh, there may be a 90-day pause. And Matt, what happened when that 90-day pause news hit?
Oh, we saw a quick turnaround, which is wild. The news doesn't have to be true for it to have an impact on the market, right? Was that later confirmed that it was not even a true statement, but still it had an effect on the market?
We got claims from the White House saying it's fake news. There's news reports going all over the place. It was wild. I was watching the mortgage-backed securities live, and I saw that we're down about 13 ticks, 0.13%. Not a lot. And then all of a sudden, we were down 60. That's big. That's going to result in a half-point increase to pricing on the mortgage side, which could result in an 1/8 or 1/4% movement. It's a pretty severe movement all to happen at one time. Since then, we've settled back down to 27 ticks. So, double where we were at the open, still going in negative direction. But, it's all just based on news right now. A lot of lenders are repricing negatively. And, unfortunately, we talk about all the different things that impact mortgage rates, the Fed, economic data, what's going on with inflation. Nothing is more important, though, than, investor sentiment. You get some news coming in from the White House. You get a couple tweets here and there. Next thing you know, money is pouring out of stocks and into bonds. That's what happened last week. Stock market's kind of tanked. Early this week, now money's going from bonds back to stocks. Bond prices go up. Yields go down. Everything is great until it's not. And now as the money leaves the bond market, those prices are coming down and the yields are going up. Mortgage rates go back up too. So let's take a look at the Fed forecast right now just to see if there's any change since we talked about this last week. We were looking at 3 drops this year. We're actually seeing a bit of a push from Trump and, from members of his cabinet stating that the Fed needs to drop rates now. And I think we're seeing this reflected right here, just to explain the chart a little bit. Prior, we had a very, very strong sentiment that there would be no rate drop in May. But this has shifted pretty severely to 44.5% are saying we will see a rate drop in May. We are already thinking pretty strong that we'd have one in June, but now it may even be 2 in June. And it may even be 3 by July. This is kind of wild here. What are your thoughts and takes on this updated sheet, Matt?
Yeah, it is. This is proof that market moving news can cause quick changes to the market. Literally had a conversation with somebody early last week, and we were looking at the highest probability was 2 rate cuts in 2025. And I remember the conversation was you know what? Just a hunch or just my guess is we might have 3. And then I'm sitting at a conference Friday morning, and I pull up this update from somebody who I follow who puts out some good information about how we've suddenly shifted to a probability of 5 rate cuts. Maybe it's not a high probability, but there's a chance that we get 5 rate cuts in 2025. The same week that if you would ask somebody that same question on Monday, the number was 2. Of most probable rate cuts in 2025. So this stuff changes quickly. I just want to mention something before I forget, Nash, because you talked about it. And you talked about, sentiment and how much that matters. It's so true. Headlines can change sentiment, and sentiment can move markets. Another example, besides this, pause that people thought was a possibility. It moved the market, 90-day tariff pause. There was all this action on X and other places, which I'm not even following. I'm just watching the headlines following that about an emergency Fed meeting today. The Fed was planning to meet anyway. They have tons of these meetings. It's not necessarily huge, but because of how it's phrased, because of kind of the trepidation in the market, that has the ability to skew this stuff one way or another. So it'll be interesting to watch. And this more than ever, you want to kind of keep an eye on, because it's moving quick. Like this thing, we'd look at it week on week, and it would change very little. Right now, it's changing a ton.
Yeah, there's tons of movement week over week. Just this time last Monday, we were saying, hey, it's pretty certain that we're going to see a third rate drop. And that's crazy to go from 5 to 0 to 2 to 3. Now looking at this sheet, we've got 1, 2, 3, 4 by October is where we're leaning. But without a doubt, 4 by December. The sentiment for 4 by December is 99%, basically 100%.
Wow.
That's insane to add another rate drop this year just like that. So, we'll see. This stuff is moving pretty quickly. I have a feeling that by the time we get to the next couple meetings, next couple Monday market updates, I think we may see that May 7th meeting start to move into the likely drop category, which I think dropping too soon, what we've seen before is when we do drop too soon, then we see interest rates shoot up a little bit thereafter and then have to settle down. So, we'll definitely be paying good attention coming up on that May meeting to see what we think. Because I do know that by the June meeting, that drop is going to feel very, very reasonable. But, having drops back to back, I'm not a big fan. But I think either way, we're going to get May and July or June and July on our first 2 drops of the year. And, we'll see whether or not that's backed by, the econ news and how it moves the market. But let's talk about the market and where interest rates have gone since we talked last. Oh, that is a steep drop, Matt. What's going on here?
Oh man, that was a fast fast drop. It's like a water park on Friday. Like I don't know about you in Texas, but out here we got the water parks, and it's the cliffhanger where you go straight down, and that's what April 4th, last Friday was. I guess it was really a combination of Thursday and Friday. So the top of the cliffhanger is the 675 we saw on Wednesday the 2nd, and then 2 days of steep decline in mortgage interest rates. It looks like it went 675 to 66. Tell me, Nash, because I'm curious. I was at a conference. I was probably pricing less loans than I would on an average day, because usually I can see like, I priced an investment loan. I also priced a primary. I priced one with 30% down. I priced somebody with 5% down. What did you see with lenders' rate sheets those 2 days? Did they change this drastically? Sometimes it's not always direct correlation between what's happening with mortgage bonds, what might appear here, and what we're seeing on rate sheets.
So the actual bond auction that took place was more aggressive than the mortgage-backed securities pricing. So we did not see the same kind of activity that we would normally expect. The drops were not as severe as they should have been, and now they're gone. What's funny is this chart was put together this morning. It's already completely out of date. The current overnight average on the 30-year fix that was, like you said, 6.6 by the time the markets open this morning is now 6.75. So
Wow.
You can go ahead in your mind and draw that little uptick, which, by the way, Matt, Texas is not a third world country. We do have water parks and amusement parks. Like I don't know if you know Six Flags Over Texas. It's Texas, man. That's where it's at. Wet and Wild started here. We are the kings of family fun entertainment. Maybe not compared to California or Florida, but hey, whatever. I'm going to take it because everything's bigger in Texas. So are our slides, but they don't go straight down and then pop straight back up all the way to where they started. So maybe that's a California thing, but we're up to that 6.75 again, which is a good, healthy spot. It's just not healthy to have such severe changes, because I know personally, I put together, scenarios on 6 or 7 refinances between Friday and over the weekend. They're going to save people hundreds and hundreds of dollars, if not, thousands over a short term. They looked great. Now they're gone. So it's a challenging spot for loan officers. And that's why we want to have things like this, is to give them those talking points so we can figure out, is this a blip? Was the 4th a blip? Looking at where we've been and where we could go, the bond market was very close to where we were in that September, October range. but we have not come close to those lows. So we may have to be a little patient, have these things put together, have those conversations, and have these targets that we are watching to trigger the need to lock. And I think it's just put a lot of loan officers on alert that you need to have these conversations early to know where someone is going to make sense to refinance. So that way, when we get there, you can pull the trigger quickly and not spend 24, 48 hours putting something together for them, because by then you may lose it.
Yeah, I agree. And I've had way too many conversations where people are like, oh, I guess you're right. 9-month break even. I'm saving $283 a month. Like, yeah, I think this makes sense. Give me a couple days to kind of sleep on it. Mm-hmm. And it's not a salesman pitch or anything to tell people like this stuff can move quick. So if it makes sense on a refinance, we're talking especially, you just have to get it in, get it locked, and get rolling. The thing about it, and I'll shut up, is for consumers, when the opportunity arises, and you made a great point, Nash, this is probably a conversation you had before. Hey, if we get in a position where you can go to 6.49% with little cost, is that going to be something you want to move forward with? Yes. Okay, cool. Let's have a full file ready. Let's be in a position where if that presents itself, we can lock it and get it submitted. That is a good strategy versus like, let's wait until it comes, talk about it, and hope that it's still there. People miss out. And then, unfortunately, what I saw a lot of people who missed that boat in October. And if we look at this chart, it's really obvious. Like 6 months later, they're still not back to the opportunity that they had back then. And so they've paid that extra $200, $250, $300 a month on their mortgage, where they could have not been paying that. They should have refinanced likely. So anyhow, as a consumer, keep your eyes and ears open, talk to a professional like Nash, and make sure you're just in a position. Some people might not even.
Did we lose Gucci? I think we lost Gucci. Kate, we can kill the slides here and just stare at Matt's beautiful frozen face there for a bit. But that was a good final takeaway. I'll go ahead and close this out with my last takeaway on here as well. And it's basically what we were saying before. The talking points this week is going to be all about the news. Is this fake news? Are these tariffs coming? How are different countries responding to the tariffs? How is money going to move from the bond market to the stock market and back and forth? What are all the members of the Fed going to say this week? And then what are the inflation numbers looking like on Thursday? So lock or float, I'm going to go with lock it if you like it. If it makes sense, if it has the savings in there, the market is too volatile right now. It's really difficult to do any kind of assessment on where things are going to go. We can't predict anything, knowing how severe the changes are being impacted just by notes that are coming out of the White House. So for this week, hold on to your butts. Look at where pricing is going. Be ready before you have to be ready. I think people that are getting caught not ready to perform on a lock, that's where you're going to lose best, because it's really hard to go back and tell someone, hey, oh, by the way, now pricing is this. You don't want to temper that excitement. You want to be ready to roll and ready to execute quickly. So that's all I've got this week. Next week, we'll come back and see how everything panned out with that. Talk a little bit more about the Fed direction as we get closer to that May meeting. And, appreciate everyone tuning in, and have an awesome start to your week.